Greetings and welcome. We know you're excited, so let's dive into today's lesson on how to buy Treasury bonds. Treasury bonds are a type of government bond that is issued by the U.S. Treasury Department to raise money to finance the government's operations. These bonds are considered low-risk investments because they are backed by the full faith and credit of the U.S. government. In this tutorial, I will explain step-by-step how to buy Treasury bonds. Step 1. Open a brokerage account. The first step in buying Treasury bonds is to open a brokerage account. You will need a brokerage account to place your order for Treasury bonds. You can choose from a variety of brokerage firms such as Charles Schwab, Fidelity, TD Ameritrade, and E-Trade, to name a few. To open a brokerage account, you will need to provide some personal information, such as your name, address, social security number, and employment information. The brokerage firm will also ask you about your investment goals, risk tolerance, and experience with investing. Step 2. Fund your brokerage account. Once you have opened a brokerage account, you will need to fund it with money to buy Treasury bonds. You can fund your account by transferring money from your bank account, mailing a check, or using an electronic funds transfer, EFT. Most brokerage firms have a minimum initial investment requirement, so be sure to check the minimum amount before funding your account. Step 3. Search for Treasury bonds. After funding your brokerage account, you can now search for Treasury bonds to buy. Most brokerage firms provide a search tool or a bond screener to help you find Treasury bonds that match your investment criteria. You can search for Treasury bonds by maturity date, coupon rate, yield to maturity, and other criteria. Once you have found the bond that you want to buy, you can click on the Buy button to place your order. Step 4. Place your order. When placing your order, you will need to specify the quantity of Treasury bonds that you want to buy and the price that you are willing to pay. Treasury bonds are sold at auction, so the price you pay will depend on the prevailing market conditions. You can place a market order, which means you are willing to pay the prevailing market price, or a limit order, which means you specify the price you are willing to pay. Step 5. Confirm your order. After placing your order, you will receive a confirmation that your order has been received. The confirmation will include the details of your order, such as the price, quantity, and settlement date. Be sure to review the confirmation carefully to ensure that the details are correct. If you need to make any changes, you can contact your brokerage firm's customer service department. Step 6. Wait for settlement. After your order has been confirmed, you will need to wait for settlement. Settlement is the process of transferring the ownership of the Treasury bonds from the seller to the buyer. The settlement period for Treasury bonds is typically 2 business days, which means that you will receive the bonds 2 business days after the transaction date. Step 7. Manage your investment. Once you have purchased Treasury bonds, you will need to manage your investment. Treasury bonds pay interest semi-annually, and the interest payments are deposited directly into your brokerage account. You can hold the Treasury bonds until maturity or sell them before maturity. If you sell the bonds before maturity, you may receive more or less than the face value of the bond, depending on the prevailing market conditions. Step 8. Consider the tax implications. It is important to consider the tax implications of investing in Treasury bonds. The interest income from Treasury bonds is subject to federal income tax, but it is exempt from state and local income tax. If you sell the Treasury bonds before maturity, you may be subject to capital gains tax. You should consult a tax professional to understand the tax implications of your investment in Treasury bonds. Step 9. Understand the risks. While Treasury bonds are considered low-risk investments, there are still some risks to consider. Interest rate risk is the risk that the value of the bonds will decrease if interest rates rise. Inflation risk is the risk that the purchasing power of the interest payments will decrease if inflation rises. Credit risk is the risk that the U.S. government will default on its debt obligations. However, this is considered a very low-risk possibility. Step 10. Diversify your portfolio. It is important to diversify your investment portfolio to reduce risk. Treasury bonds can be a good addition to a diversified portfolio, but you should also consider other types of investments such as stocks, mutual funds, and exchange-traded funds, ETFs. I hope this tutorial has been helpful in explaining the step-by-step process of buying treasury bonds. To summarize: 1. Open a brokerage account. 2. Fund your brokerage account. 3. Search for treasury bonds. 4. Place your order. 5. Confirm your order. 6. Wait for settlement. 7. Manage your investment. 8. Consider the tax implications. 9. Understand the risks. 10. Diversify your portfolio. Remember, investing always involves some level of risk, so be sure to do your research and consult with a financial professional before making any investment decisions. If you have any further questions or need additional assistance, please do not hesitate to contact your brokerage firm's customer service department. Thank you for learning with me today. Good luck with your investing. Thanks for watching our video. If you found it helpful, please consider liking and subscribing for more content. Our goal is to help and inspire you, so let us know what topics you'd like us to cover in the comments below. Don't forget to hit the notification bell to stay updated.